if you're a high-earning German, your tax bill isn't your biggest problem. It's what's coming next. Listen, Germany already takes up to 45% of your income. Now, add the solidarity surcharge, complex reporting, tightening rules, and the continuously expanding exit tax. And you're looking at a future where keeping your wealth becomes harder and harder every single year. This is why wealthy Germans are restructuring, relocating, and rebuilding their financial system in 2025. Legally, strategically, and with urgency. I'm Thyll, brand ambassador at Ancova. Now, let's break down exactly how they are doing it. Germany is now one of Europe's highest tax jurisdictions. Firstly, personal income tax. It's up to 45% for income above 277,000 euros. Secondly, in addition to that, you have solidarity surcharge, which is around 5.5%, pushing the effective rate even higher. Now third, corporate and trade tax is around 25 to 30%. And look, once you withdraw profits personally, you're taxed again. Fourth, wealth tax, inheritance tax, asset reporting debates. Look, constant political uncertainty equals a higher long-term risk. So, for many high net worth individuals, the effective burden on income, dividends, and business profits can reach close to 50%. And this is why planning is no longer optional. It's self-defense. And here is the part most people ignore. If you hold just 1% of shares in a company, Germany can tax you as if you sold those shares the moment you relocate, even if you didn't. And from January 2025, the exit tax becomes even tougher. Applies to more asset types, includes certain investment fund units, can generate tax without any actual sale, and finally can trap entrepreneurs if they leave unprepared. Now, without proper structuring, relocating could trigger a massive tax bill. And the smartest Germans are preparing for it now, not after the rules tighten once again. Before relocating, wealthy individuals are restructuring. Common steps include, firstly, setting up an international holding company, often in the UAE or Malta, to hold their global shares and income streams. Secondly, revaluing or freezing assets before the exit to actually lock in today's gains, not tomorrow's tax exposure. Thirdly, separating business from personal income to avoid unnecessary triggers under the German tax law. Fourthly, planning residency timing to eliminate dual taxation risks during the transition year. Fifth, using double tax treaties to defer exit tax without proper planning. Exposure can be reduced or even deferred legally. And this is why restructuring before leaving is absolutely crucial. Now, let's break down where wealthy Germans are moving and why. Well, first of all, United Arab Emirates, Dubai or Abu Dhabi, the #1 relocation hub. 0% personal income tax, 0% capital gains, wealth or inheritance tax, 9% corporate tax, often zero if for qualifying free zone companies, long-term residency via company setup or investment, strong Germany-UAE double tax treaty. Now, UAE is about freedom, safety, and no hidden tax traps. At second place, we have Cyprus, one of the EU most favorable regimes. Non-dom system, foreign dividends and capital gains are completely exempt. Plus, you get 50% exemption on high foreign employment income. You get a low corporate and personal tax. Plus, wow, you get the Mediterranean lifestyle, plus EU protection. Third, Malta, a remittance-based system. If you don't bring foreign income into Malta, it's not taxed. You get EU residency, strong legal plus banking systems. It's controlled and predictable taxation, extremely efficient for investors and entrepreneurs. As fourth place, we find Switzerland. You know this well. some cantons, such as Zug, for example, they offer lump sum taxation based on lifestyle, not global income. And this works only for foreigners who don't work locally. And it's actually one of the reasons why wealthy individuals choose Switzerland for privacy, stability, and elite wealth management. At fifth place, we find Monaco, my classic. 0% personal income tax, highly private, extremely safe, preferred by ultra high net worth families. Now, residency requires actually physical presence. But look, the benefits are clear. Now, not everyone wants to relocate, and that's perfectly fine. You can still reduce exposure by using foreign holding companies, diversifying assets across jurisdictions, separating business from personal income, building family offices or foundations abroad, optimizing transfer pricing, ensuring global reporting is correct, restructuring dividend flows. So sometimes going from 45% to 28% is just a matter of structure, timing, and advice, not relocation. More German families are adding a second residency or citizenship for flexibility. European residency options are Portugal, Italy, or Greece. Italy's lump sum taxation and Greece's flat rate expat laws are extremely attractive. Now, citizenship programs, as for example St. Lucia, Dominica, Antigua and Barbuda, these give you mobility, banking diversification, geopolitical safety, and actually long-term freedom. Because mobility isn't about escaping. Mobility is insurance. Germany's direction is clear. More reporting, more taxation, more exit restrictions, and eventually more financial pressure. Because those who plan early, they keep control. Those who wait will pay the price. Literally. Look, if you want to protect your wealth, reduce exposure, or relocate strategically, Ancova can guide you through every step. Fully compliant, globally optimized, and tailored to your goals. I'm Thyll, brand ambassador at Ancova. Thank you for watching. Subscribe for more insights on global tax and mobility.